focus of producers and where they're drilling has changed based almost entirely on the value of what they're producing. So if we look at the prices of natural gas and crude oil, you'll see that up until about 2009, the red line is natural gas prices in dollars per metric MMBTU. On the left axis, the blue line is crude oil prices. On the right axis, these two roughly follow the same path. Their ratio is reasonably constant, about 7 or 8 times. So crude oil prices are about 8 times higher, 8 times the gas price. After shale production starts up in 2009 on a significant scale, natural gas prices fall significantly relative to crude. And that fall occurs because the production of gas from shale simply out-supplies the market. So there's a surplus of production which causes downward pressure on prices. With natural gas, because it's harder to create a new market for gas. You can't just conjure up new demand until you build export plants or you build generating capacity. That means that the price is pushed down. It goes down in 2012 to about $2. By contrast, the price of oil stays high and has continued to stay high. As we produce more oil, we're simply replacing imports. The price is set at the international level, so it stays high. What you find, though, is that the drillers look at the falling price of natural gas and then start to move their rigs towards liquid plays, because the returns from drilling for liquids are far higher. So although all of the original work on shale was done to produce gas in the mine shale, as gas prices fell, producers had experimented and mastered the techniques of using drilling in liquid plays, so they moved to oil. And even though there's been a boom in oil production since then, the price of oil has stayed high because you're replacing imported crude oil. So price is important in terms of where producers drill. Also important in terms of crude oil to understand, or any kind of valuation or understanding of where people drill, is quality. Now again, I'm coming at this from 20,000 feet and apologise to those of you that are actually more expert than myself. But crude oil quality basically can be brought down to 2 essential components. The first and most important perhaps is the gravity, which is the density of the crude. So crude is either heavy or light. If it is heavy, then that means that it is typically thick or harder flame or dense, and it's harder to refine. If crude is light, then it's easier to refine. Again, broad terminology here. Essentially, the way it's measured is in API, degrees of API. That's the baseline is water, which has a 10 API. If it's heavy crude, then it has a low number. So Canadian oil sands has an API of about 8. If it's very light crude, it has a high number, perhaps as high as 55 or 60 API. The very lightest crude or condensate. So that determines its value to a refiner to some degree. And the other major characteristics that determines the value is sulfur content. If crude oil has a lot of sulfur, it's known as sour crude. Sulfur is undesirable because it has to be removed during the refining process to meet environmental regulations, and therefore it's expensive to refine. So given the choice, refiners prefer light and sweet crude to heavy and sour crude. And this categorization of those crude oil qualities is one provided by Turner Mason, refining engineers, and they're basically giving names to particular ranges of crude oil, heavy, medium, light, based on the gravity and the amount of sulfur. So sour crude is more than 1% sulfur, sweet crude is less than 1% sulfur, and so on. You can see the range of APIs. And the problem is that these categories are essentially not determined, are determined by individuals. There's no agreement on this. It's essentially a matter of the individual judgment. Again, digging a little bit deeper into crude oil qualities. Once you go to a refinery, here we're looking at basic distillation. This is a distribution of the products, the refined products that will be output from a typical barrel of conventional crude, light sweet, like West Texas Intermediate, the US benchmark. And what we see is along the bottom is the volume range, and on the side is the volume of output. So the distribution here shows a high distribution of naphthas and distillates, which are of value to a refiner to produce gasolines and diesel. So that's where the value lies for a refiner using conventional crude oil. At the tails of the distribution, on the right-hand side, if you have a crude which is heavy, it will have much more of residual fuel oil. If you have a crude that's very, very light, it has more of the natural gas liquids, so it's going to be lighter. Talking about some of the challenges that these quality of crude presents at the wellhead, and this is the operational experience. Crude is clearly not a homogeneous commodity. It doesn't all come out the same. Every well can be different, and basically during the lifetime of a well, you can get a different mixture of hydrocarbons from each well. And these properties actually make practical difficulties as far as transportation goes. So for example, if you produce a particular grade of crude oil, maybe you think it's really good, and you have to get it to market in a pipeline, more or less inevitably it's going to get mingled with someone else's crude, and so there's going to be issues about what is the quality of the crude that you deliver to the final refiner. And this creates a lot of problems in the distribution process. And of course this is also an issue for accounting for the value of that crude. Looking then again at the boom in shale crude oil production. This is a look at crude oil production for, in blue, the lower 48 in the US, and then the green is Alaska. Essentially, US domestic crude oil production peaked in about 1970 at just under 10 million barrels a day, and another peak in the late 80s when Alaskan crude boosted that up to around 9 million barrels a day. And then ever since then, between 2009, we saw a steady decline in output. And what's happened in the last 3 years is we've seen a dramatic increase from the production of crude oil from shale from around about the middle of 2011. Dramatic increase in output of crude oil. Looking at a shorter period, that's where we are today, and then this is the forecast that we use, which is, as stated, as John said, is used. It's based on drilling the decline curves. So these forecasts tell us that production will continue to increase and will exceed the record of 10 million barrels a day. So by 2019, we'll be up to 11 million barrels a day of US domestic production. But this crude oil that's being produced, the new shale crude, is different to what we've seen before. Just a few slides here to show where that crude is coming from. So what is the basin, the Bakken, production there. Look at these charts. These give forecasts forward to the end of 2019, and you can see in all of them that things take off in about the middle of 2011. So this is North Dakota, the Bakken, and right now it's about just over 1 million barrels a day, and predicted to go all the way to 1.7 million barrels a day in the next 5 years. Niobrara in the Rockies, right now it's about 350,000 barrels a day, again going to about 650,000 in 5 years, based on these estimates of the output of the wells. On the decline curves, we have Anadarko in the mid-continent, right now it's around 350,000 going to 500,000 barrels a day. And then the big kahuna, the Eagle Ford, and this is quite incredible. You can see in 2011, production is about 50,000 barrels a day. And all of a sudden it takes off like a rocket. And right now we're kind of at the top of that peak. around 1.3, 1.4 million barrels a day, and it seemed to level off as production is declining in the next period, will only increase to 1.7. And then the grandfather of US oil, the Permian Basin in West Texas, been producing since the 1930s. Up until 2011, we were hovering just under 1 million barrels a day, and then it takes off again in that period of explosive development. And then now, the red piece you see on the top is that they've just started in the last year or so to do extensive horizontal drilling, and that's producing far higher output, so the forecast is really increased and expected to get to 2.5 million barrels. So production of shale is going gangbusters. That's great if you live here in the USA, there's plenty of oil to come. But in terms of the quality of that output, something very interesting is happening, in the sense that many of these plays are increasingly producing lighter crude oil. So this chart shows on the left-hand side the particular fields or plays, and on the top the API gravity. Remember that the lower numbers are heavy crude, and the higher numbers are very light crude. So if we look at the range of API gravity of the output from all these plays, you can see that there's a pattern that from the shale, output is getting increasingly lighter and moving over to the right-hand side to the very high APIs, up as high as 65 in certain parts of the output. So what we're seeing is, although there's within this broader trend of a big increase in US production, we're getting a much larger output of lighter crude oil, which is light oil, but also it crosses the line towards condensate. Condensate is kind of well, I'll give you a little definition from the SEC. This is a wonderful word definition, which you guys can read it, but basically what they mean is that condensate is a gas under the surface at a high temperature and pressure, but when it reaches the surface it turns into a liquid. And this has become a key operational issue for US production and distribution systems, particularly in the last year or two, as more and more of this lighter crude oil is being produced. It's a greater amount of condensate, and from an accounting perspective, condensate in the US is traditionally always been classified as crude oil. So if it's a liquid at the surface, it's a crude oil. So it falls into the bucket that says liquids versus gas, which goes off into gas and NGLs. And that definition is something that the government uses. The Department of Energy define condensate at the least in the field as crude oil, and indeed the Bureau of Industry and Security, who regulate in particular the rules for the export of crude oil. If you're aware, there's an issue about US crude oil not being allowed to be exported. Well, under their regulations, they define condensate as crude oil, so therefore it falls under the crude oil category and can't be exported. So what we have is a very big increase in production of a commodity which is kind of like a crude oil, but is actually very similar to a natural gas liquid. So in fact, what's happening at the surface is that as well as just oil and gas, the oil itself could easily be categorized as crude oil and condensate by some further definition. And in fact, in the US, they're all bundled together, but in many other parts of the world, condensate is treated as a separate commodity, and condensate can come not just from production of wellhead, but very similar material is produced as natural gas liquids in the form of natural gasoline. So generally speaking, the increase in production from shale is having an impact on making the output of crude oil from the US production have a higher API. So crude oil is getting we define condensate as having greater than a 55 API. This is the production from each of the fields up until the end of 2013, basins, shale basins in the US. And you can see that the one blue area there, the Eagle Ford, is producing significant amounts of condensate. And some of those wells, it's up to 40 or 45% of the output is condensate. Which is fine in and of itself. It's a liquid, it still has value and it certainly has uses. But the challenge has come for the industry in particular. This is an issue where increasingly investors need to pay attention to categorization of condensate because it now has a lower value in the marketplace. So if we look at crude oil formations and say this is a location where it's producing a lot of condensate, then potentially the value of those reserves are lower than those producing more conventional crude oil. So as an example, if you look at the price of conventional light sweet crude in the US and the Gulf Coast, where most of the refining occurs, this particular crude in the blue line is light Louisiana sweet, and the prices in dollars per barrel since the beginning of 2013. And then comparing that price with the price that a producer might get for condensate from South Texas Eagle Ford, and those prices are significantly lower. Why is that? The reason is that condensate that's very light crude is less valuable to US refiners because their refineries are not well configured to process this lighter crude. Refineries have been built to either configure light sweet crudes, or in fact in the US Gulf, in the past 10 years, much of the investment in refining has been to build refineries to process heavier crudes on the premise that we were running out of the good stuff, that all the light stuff was being used. So now we have a situation where a large part of the refining capacity is configured to process really heavy crude, and now we have an abundance of really light crude. Essentially what happens with condensate is that if you process too much condensate in a conventional refinery, it kind of froths out. There's too much light ends in it, and it overwhelms the system, so you have to reduce the amount you put through. Anyway, as a consequence of that, this value of condensate is now low, and in this particular case, if we look at the prices since 2013, over time the average there is $14.50 a barrel lower than light Louisiana sweet, and at times it's been as much as $25 lower. So this has implications for understanding the quality and the value in the resource chain. So backing out to kind of the high level of reserves and their measurement, we look primarily at oil and natural gas when we look at reserves estimates in accounts. This is an example on the right of the BP reserves. And essentially everything's divided into liquids or gas. Hopefully the issue that we're seeing right now in the field is that there are different types of liquids and they have different values. So this has an impact. The quality of what is being produced has an impact on valuation. So could we do much about that? For example, could we have some fixed definition to say that instead of a wordy description, condensate is now 55 degrees API or above? Yes, that certainly would be possible. We could require condensate to be segregated at the wellhead. You could ask for more specific crude classification in the county. So that let's report the crude should be defined as heavy, medium, or light based on some categorization. But the reality is, for sulfur content, reality is though that that's really not practical to implement. Obviously the output quality varies over the life of the well, so it's very difficult to understand what that may be. The big thing is that most of the time, crude oil on the way to market or even the wellhead is blended together. So a typical producer in a shale would output some condensate and maybe just blend that together with crude oil in order to receive the higher price of the market. And obviously this is very different from a discussion of the reserves, which are all below the surface. Again, trying to provide here is just some insight into some of these issues at the surface and how they might impact what's going on in terms of understanding what's below. And of course, no producer has any incentive whatsoever to simply say, oh yes, put their hands up and say all of my reserves are condensate and they're worth less. When if you say they're crude, there's something worth more. So it's definitely an issue that is happening right now in the field, causing problems at refineries when this stuff's delivered to them. So,
yes, sir. Yes, sir.
But the reality of this is that this is an issue not to do necessarily with reserve accounting, but understanding quality risk associated with any of these reserves. The point here is that the hydrocarbon values that we look at to determine where people are drilling. As John said earlier, much of the production is coming out early. Initial production is very high if we don't know about the ultimate recoverable resource. And there is an impact of regulation on values, so that if, for example, there's an export ban, then the value of that crude or condensate may change over time. So a lot of changes in the nature of shale drilling are changing the way the industry works and making it more difficult to get a handle on the valuation. So to summarise, we looked at the output, the value of different hydrocarbons, we looked at the booming production, and the fact that the quality of crude oil is definitely changing. Even though that's not measured at all when we look at reserves, even though what we're seeing in the field is that there's a lighter value to some of the shale output that could lead to overvaluation of production. But it's very difficult to fix that. It's quite impractical to institute more clear measures at the surface. And again, just finally, that these drilling economics of shale are changing the way that we look at valuation. And that's all I have for this afternoon. Thank you very much. If you're interested to look at the blog, this is the link to follow. You can do this on a daily basis.
We have some time for questions. I'm going to take the moderator's sort of privilege and ask the first one, but please come up to the microphone. So, many of you may be aware of the crude oil export issue is becoming a major issue, and it's only going to grow. How big an issue it is, largely because the amount of light crude that we import that can be displaced is basically, we run out of what we can do there in terms of refining configurations. And so Senator Murkowski actually testified about a month and a half ago, I guess, but that was because I was actually there, about changing the rules about how we define condensates, separating them from crudes, largely because she is hopeful that that will sort of unleash a certain amount of liquids volume that can be sort of exported into the global market. You showed Sandy, you showed the graphic about price, right? And this, of course, has a major implication for how we actually value what we lift. But if condensates were formally reclassified and therefore allowed to be exported under the Department of Commerce's rules, do you think that would change in a major way the way we actually value condensate production? Because would that, for example, collapse the spread that we see currently? I guess another way to say it is the spread we see currently largely because of the export ban, or is that driven by something else?
Yes, the spread's definitely driven by the export ban, because the reason the price is lower is because there's too much supply and not enough demand. Refiners don't want condensate, so the price is discounted, and meanwhile it's coming out of the ground like there's no tomorrow. If it is permitted to export condensate, there are already markets for it, particularly in Asia, that will pay a premium price for it. So if you look at the price for condensate, which is sold on par with crude in the Far East, then those prices are about $1 beneath US crude prices. So instead of facing a $14 discount, you get an equivalent price. So definitely.
And one question for John. You mentioned the previous, the concurrent session actually in your talk about how the ARCS equation that was sort of raised, and you also mentioned it was actually me that raised the comment about the UT work that sort of really shows that the ARCS characterization of the resource is not accurate when you talk about these very low permeability, low porosity reservoirs, and that goes back to models of physical flow or radial versus linear flow with the map, basically. But you also mentioned that you need to drill a lot of wells to characterize the resource, and I think that's very apt. And not that there's a sort of perfect number, but when you start thinking about classifying reserves and really understanding how these shales perform, is there a sweet spot, if you will, in terms of how much drilling activity is required to fully characterize a shale, or is that really as heterogeneous as every shale is?
Well, it's tempting to oversimplify, but at least I will simplify. On the order of 50 to 100 wells is a minimum to have reliable statistics to characterize at least the area in which those 50 to 100 wells lie. Less than that, there's a great deal more uncertainty as to what results will be.
So when you say area, you're talking about the drainage area, because I mean some of the area that's in some of these shale places is massive. So,
well, no, I meant the area in which the 50 to 100 wells have been drilled. These shale plays are so massive that, to characterize the entire formation, we're talking about thousands of wells. But, 50 to 100 in a portion of a Texas county in the Barnett Shale, for example, which appears to have similar geological characteristics.
Yeah, I asked that question because oftentimes as economists, when we think about using resource data to ultimately understand what technically recoverable resource will be, and then translate that into something like a reserve outside of North America, and you hear about governments, for example, China saying we're going to drill 50 to 100 wells in the Sichuan province. I mean, that really doesn't. And the point here is that really doesn't tell you very much about what that shale resource is going to yield. So that sort of builds on what John's saying. So go ahead.
Yeah, those are very good points, by the way. Robert Kleinberg from Schlumberger. Two quick comments and then a question. First comment: I read the RBN blog every day, and it is awesome. Second comment for Mr. Lee. The reason why the volumetric method has not been used very much for the estimation of resources, for shale resources, is that the log analysis procedures haven't been sophisticated enough until recently to really distinguish, for example, kerogen from oil. And that's been a big limitation that with modern nuclear spectroscopy and magnetic resonance logs, I think you'll be seeing more of that volumetric type evaluation that's going to be more reliable. The question is there any value in the concept of stimulated reservoir volume, or is it just too uncertain and we have too much ignorance about where fractures are going to make it meaningful?
Well, that's a very good question. I don't believe we can define the size of the stimulated reservoir volume based, say, on microseismic surveys. All we see there is seismic events, which may or may not be fractures. I do think there's value in the concept, though, which we can find from modeling the reservoirs and determining from production performance what the volume of the reservoir that's actually being drained appears to be. So a performance-based determination of that stimulated reservoir volume, I think, is still very valuable and very valid. And among other things we find in modeling is that the flow capacity within the stimulated reservoir volume, within the part of the rock that has not been hydraulically fractured but is just near hydraulic fractures, the effective flow capacity appears to be 1 to 2 orders of magnitude higher than the effective flow capacity outside that area, and I think that's very important in helping us to establish what ultimate recovery will be.
Can I just have a quick follow-up? Sure. Well, okay, so getting the stimulated reservoir volume by working backwards from production, I mean, then you need some information about recovery factor, which is the most uncertain parameter in the entire problem, right?
Well, we have certain observed recovery up to the time that it looks like we're draining a certain fixed volume. So at that time, we know the volume, we know how much we have recovered at that point, and so we can back into an apparent recovery factor at that point.
From the transient.
Correct.
Thank you.
Fred?
I have a question for Mr. Fielder. This is along the lines of Ken's, but are U.S. refineries doing anything to reconfigure so that they can accommodate the lighter oils and thus perhaps reduce the discount on them? And
Yes.
how quickly might that happen?
Yes, clearly, the longer there's a ban on exports, the pressure increases on refiners to address the issue of a lighter slate of crude oil. In the short term, ironically, the more production increases, the downward pressure on prices is definitely to the benefit of refiners, so they're happy to sit and wait. But from the perspective of changing configurations, actually it doesn't require significant investment. Many refiners, Valero, Marathon in particular, are making changes. And there is also movement to build about 800,000 barrels a day of capacity or something called condensate splitters. So there are a number of projects that are on the drawing board, and these would be specifically developed to split condensate into its component products. So instead of exporting it, you just split it into products and export those because they're fine for export.
My name is Mamdouh Salama, oil economist and consultant to the World Bank on oil and energy. During the conference, I heard different numbers on the shale tight oil production this year in the United States. Can you tell us exactly what the actual figure? That's one question. The second one, short one, is given the steep declining rate in the production of shale tight oil, how many thousands of wells are being drilled in the United States every year just to maintain production? Thank you.
Well, to answer the first question, I don't know off the top of my head, are you saying specifically the shale output versus the whole? Just the title. No, I don't know off the top of my head other than obviously if we look back since 2011, which is really when that began, then since then we have the latest numbers I have are like 8.4 million barrels a day for total US production. And so if we take off from that, it's still an estimate, and it's still something like 2.5 million barrels a day. That would be there.
And the second question?
The second question is often asked, and I'm not by any means an expert to answer, but my understanding is that, in effect, the issue in production is return on investment. If you're drilling and you get your money back in a year, you drill as many wells as you need to keep making a living. So yes, there are a lot of wells drilled because there's a high decline rate in those wells. But in effect, the initial production from new wells is what's pushing those charts that you see, the big dramatic increases. This is the very high initial production where the decline rate is 80% in the first year, so you're getting a massive impetus to production. So yes, there's a lot of wells, but this is what makes it very unclear about the ultimate recoverable resource.
No, but since the depletion rate is so fast, you mentioned in the first year it was 80%. Just to maintain production, obviously you need to drill more wells. How many do you estimate per year the United States drill?
I don't know.
I could just comment on that real quickly before the last question. A lot of the answer to your questions, it's very price sensitive, right? So this is where the intersection of economics and commercial recoverability and policy becomes very relevant. And this is an issue that a lot of operators in the field have raised when they get to the issue of demand responsiveness and ultimately the ability to export crudes. This is actually an issue that Senator Murkowski raised when she proposed her redefinition of the crude sort of slate to exclude condensates from that sort of slate so that you can export it because it gives you potentially a price lift. And so when we talk about how many wells will be drilled to sort of maintain production, much less grow it, it really comes down to an issue of what's the price, right? And when you think about the number of wells that are drilled, I know in the gas arena, for example, when you start talking about the number of wells that are being drilled in the Barnett Shale on an annual basis, you're talking about anywhere between 1,000 and 1,500 wells a year. So it's a big number, and that's a single play. When you go to the Marcellus, the numbers are equally as massive, and wells are a lot more productive. And this is an issue that was actually raised in the session prior to lunch. But one of the things that makes it difficult to assess decline rates in places like the Marcellus, particularly liquids, is they're actually choking production initially because of infrastructure constraints. And so, what is that decline? What is that well performance? That's highly uncertain at this point. So, I think the story's still being written in this space.
Okay, I'm Bona Anisi from National Institute for Policy and Strategic Study, Nigeria. My question is, based on the increase in the exploration of shale gas in the United States, how does it affect the investment of a major U.S. corporation to outside the U.S.? How does it affect investment? And if it reduces the investment, what is going to be the effect to the balance of trade between the United States and other major trading partners?
I'll take a stab. What we do know is that the biggest benefit to US industry from shale is cheap gas. Low price natural gas means that the fuel of the manufacturing industry is competitive in the US. The impact of that is that, as you suggest, large areas of manufacturing previously effectively outsourced abroad are now at least considering returning to the US. I'm not sure I really, so I know that to be a factor, but I don't know what the impact is on international trade, except that clearly it's good for the US economy, and I think that what we're going to see is that the US is going to export a significant amount more production of materials where energy is used in their manufacture.
I'll sort of have one final comment on that question, and then we'll close the session for a time. But I think the answer to your question is largely dependent on stability outside of the United States. And when you look at what's happening in Iraq, when you look at what's happening in Europe, it can either create situations where, look at what happened, it's happening in Nigeria, right? Create situations where it might actually be more attractive to induce capital flow to the upstream sector or less. And to the extent that it's less attractive, the U.S. looks like a much safer place to develop, spend capital and develop resources. But there's the countervailing wind, which is current policy in the United States and the uncertainty that actually exerts with regard to how much profitability there will be longer term in the oil play in particular, and even in the gas play to the extent that exports can be expedited and things of that nature. So there's a tremendous amount of uncertainty. John mentioned uncertainty in reserve assessment, right? Resource assessment. There's an equal amount of uncertainty above ground that really speaks to your question. So, these are, to use the current phrase, uncertain times. And arguably, what's happening below ground in regard to assessing reserves and assessing resources. So very different sort of characterizations of what's in place. In the United States, there's a lot of uncertainty there, but above ground, there's equal amount of uncertainty in where capital is going to flow and ultimately how much resource is going to be assessed outside of the United States, and what those assessments will mean for reserves is largely contingent on how much capital is put in the upstream. So the story, oftentimes, this question's asked, where are we if we use a baseball analogy in a 9-inning game? Right? And you'll hear all sorts of different sorts of discussions. In the U.S., I would argue we're probably in the 3rd inning. Outside the U.S., in some places the first pitch hasn't even been thrown. So there's a lot of uncertainty there. So with that, let's join me in thanking thank you all, and I believe we're at the beginning of a coffee break outside. So.
I should.